All right, so first of all, Salamander. So we are a team of experienced C-suites. We all have pretty long 20 to 35 years experience in executive experience. And we are really committed to help earlier stage tech startups to avoid these pitfalls, but also actually to have the level of governance that is required for the company to grow to its true potential. We have a pretty global team from North America, Europe, Middle East, Asia. We're pretty present in 14 countries with about 60 of us. All of us have pretty strong experience across various type of engagements and type of corporate and startup experiences. And basically, we put these two contributions to the projects that we are taking on board, right? But essentially, that commitment is what we are all about, working with tech startup to help them through three major typical hurdles. One is the funding side, which is primarily one of the core focus of my practice, navigating complexities of raising and managing investors in general. Second is really about how to have critical talents in two stages, talents that you need today in terms of visibility, learning, and so on, and talents that you need day to day in terms of the execution. So here we are providing more the top tier expertise to help you to plug the gaps that you identify into your businesses and basically driving you to your next stage. And finally, the market side of things in how to get into new markets across the world throughout our network. But essentially, what we are focused on is to close the gaps that you have identified to help you to have a pretty much grounded visibility of your business and providing you with the tools with pretty much the hands in the engine. So we are not your traditional consulting firm. We are really here to be hand-holding into the execution of your next stage to help you to achieve your goals. So fractional C-suite, so tech companies, we have three main practices. One is finance that I lead. We have one on operation that basically encompass anything from a chief of staff to chief product officer to the tech stack and then the go-to-market side, which is basically primarily geared toward your sales and marketing side of things, right? But part of this ecosystems, we are working very closely with a number of VC firms, especially in Southeast Asia, from seed to Series B, primarily helping them to actually enhance their portfolio company. We are in the context of quite a lot of challenges both for both VC firms and for startups in terms of funding. And basically the focus on efficiencies and the focus on operational kind of improvements is core to both investors, allocators, capital allocators, but also for startups to be able to actually capture fundraising potentiality, but also customers as well. We are about north of 60 C-suites across 14 countries. In addition to this, we have actually a wide network of more operational finance professionals who are helping us to do shoulder-to-shoulder assistance on day-to-day finance. But in terms of C-suites, 14 countries, north of 60 C-suites across the world. To move on into my own profile, I'm French and German. However, I only worked in Asia Pacific. I've been in Asia Pacific for 25 years. I have a number of experience within companies, but also with capital allocators. As we can define CFOs, you have actually really three types of CFOs, right? So you have CFOs that are managing the day-to-day and managing your control and control in terms of budgeting and providing you all the resources to manage your companies across different phases of growth. You have CFOs that are really focused on more the external resources, whether they are relationship with banks, with investors, with any external resources of capital. And then you have CFOs that are really focused on risk and governance. And these are pretty much in kind of order of scale, what type of profile actually we are providing, but also what I experiment both into my appointments within companies as well as with capital allocators. And I hope I can share with you some of the experience. I've also been in the trenches. I've been full-time startup founders. I've been on boards of several family offices, including into investment committees that are deciding for allocation of capital, still advisors to a couple of VC funds, and I've been advising startups for a number of years. But I've been also in the trenches, setting up our own companies. And finally, well, I hold an executive MBA from INSEAD and Tsinghua SEM, which allows me to actually have access also to a larger network of like-minded people, both from the impact kind of side of things with INSEAD, but also on the tech side and access to China with Tsinghua. Quite interesting from some of the key mentors and key fellows that I've interacted with and build reports in terms of supporting the startups I've been advising so far. So again, I've been mostly on the CFO with external kind of position to it. So mostly on allocating capital or preparing companies to raise capital. But we have a large kind of finance teams that are addressing the other type of CFOs so that we can service our customers with their needs as they grow, right? But my primary focus is on external, and that's going to be the angle of this presentation. So that's a little bit of about me. Let me dive in really straight on into the subject of the seminar. Basically, why is finance important? I think a lot of founders, and I've worked with a lot of founders in highly technical type of startups, will very often discard finance as really a back office type of thing and not really a priority in the show. The way I'm explaining this is that basically finance is not just about compliance, which means tax reporting or what you have to actually report to ACRA, or just spreadsheets and numbers to be crunched on. But it's really about making better decisions. So that more strategic level of finance actually should be built into day one and having an understanding of finance as being an assistant to make better decisions rather than a pure compliance or back office kind of function. And I think this is quite important, especially in the world of AI, in the world of more technical kind of startups that are prioritizing their products, which is actually fair enough. But finance should be actually part of this strategic decision making, especially in the context of uncertainty that we are facing, not only in Asia Pacific, but globally when it comes to the funding world, but also in terms of actually capturing customers in the current context. So for me, finance is really providing with a lot of clarity on optionalities in critical strategic decisions, right? That is really the value of finance for founders. Really, how can we quantify actually the value of hiring, the unique economics, how and why, and how much it's going to cost to enter a new market, right? Or a new market segment. How to quantify and qualify a potential investment that is critical for the companies to grow, whether it's organic growth, right? Or whether it's actually inorganic growth, acquiring another company, or whether it's actually about preparing for the next kind of fundraising, right? So that's one of the big part that I'm primarily focused on. And the other side, which is dependent of the other CFO kind of role, is how to build better control, how to manage risk as the company grows, and essentially evolve that control and management of risk as a company evolves into critical stage, right? Again, most startups don't die from lack of ideas, they die from cash mismanagement. Running out of cash or mismanaged cash is really at the core of it. All right. So we're going to deep dive into critical kind of high level challenges or mistakes that founders, including myself, have done before. I will not tell you which one I've made, but I will provide you with a bit more visibility on the key categories that will hopefully you guys as founders or you guys as as capital allocators on how to actually offset or mitigate the risk associated to this. All right, so the first statement, cash is king. I think everyone has heard about that statement. A lot of founders are confusing revenue with cash. There's a bias of optimism, which is actually one of the key drivers with a lot of founders, which is actually a good thing, right? It's also a way to absorb the volatility. It's also a mental health kind of aspect to it. But essentially, you need to be really on the ground when it comes to having a dichotomy between revenue and cash, right? So a typical statement that I heard before in startups saying like, we close 1 million contracts, that's it, we are flushed, let's go and invest, right? Let's go and spend money, right? So we are safe, yeah? But again, revenue cannot be treated as cash. Already earned or usable until it's actually drawn down, right? So liquidity is one of the kind of bias or the one of the aspect that many startups are overlooking. And the main reason is because you are getting tractions, right? You start with smaller customers who are paying upfront. Once you're signing up your big kind of clients, it increases your valuation, but it also constrains your liquidity, right? So this balance, both emotionally and in terms of process, needs to be absorbed with certain discipline. And liquidity is really at the core of this. And so it's important to have the proper tools accounting for time, right? Accrual accounting doesn't actually compound. And so most of the startups challenges in the first kind of stage from seed to Series A are challenged with working capital, right? And working capital is basically the core of the liquidity management, right? So in terms of three kind of points that are very important here and what we're implementing with our clients and that we are advocating all startups to advocate to, but also supported by a lot of capital allocators who are aligned with this, is one is really track cash in the bank. That's the most important. Cash is king. Monthly burn is basically how your fixed kind of cost are needs to be serviced, right? And here in the monthly burn, you have actually waterfall, tax first, then all your debt, if any, and finally, basically all your commitments, whether it's rent and payroll, right, should be the top priorities into this ban, right? And finally, how you manage your runway, which means how long you have actually in terms of cash to cover your monthly burn. Yeah, managing your runway is even more critical today as it was before, as capital allocators are now focused on profits rather than growth, right? So your path to profits is more important than your growth path, as opposed as it was I was only a few years ago. A good tool is cash management forecast over a 13-week cycle that basically enable you to actually foresee any shortfall of working capital. You can predict basically your cash cycle, right? And finally, do everything you can to improve your cash cycle. So as soon as you have a customer, just implement new procedures, new process to invoice as fast as possible. Collect your invoices as aggressively as you can without actually jeopardizing your relationship with your clients, and basically negotiate as best as you can the shortest payment terms as possible, right? Your requirements for working capital are going to be a core subject of your finance over the growth of your company. And that's going to be pretty much like the later you can actually push this back, the better, right? But again, you're going to be a startup facing large balance sheet customers, and you have to balance the commercially valid scenario or strategy with your ability to service these customers, right? Profit is theory, cash is reality, right? So whether you actually have signed up a contract for $1 million, it doesn't mean you have $1 million in your pocket until it's collected, right? So that's an important kind of bias that needs to be pretty much core for startup, especially earlier stage startups when they start dealing with large balance sheet customers. All right, so what gets measured gets managed. I think you all heard about this adage, but essentially it comes through an additional bias of early stage founders is not knowing their unit economics. And that comes from probably a generation of founders that were primarily rewarded by having an aggressive growth path, right? We are now shifting into a new world where path to profits is the most important, and management of cash and basically management and measured and managed unit economics becomes really core to it. So an example of a statement from the former type of mindset is we're losing money on each customers, but we're going to make it up in volume, right? That is really in the unfortunately previous generations of founders that were capturing capital from capital allocators. This doesn't actually fly anymore. I think managing unit economics is very important to capital allocators, but also actually for building resilience for a startup. Again, having this kind of mindset of saying like growth at any cost, with basically postponing problems, and the problems will scale faster than solutions. So that's a very important element that needs to be considered when it comes to finance in early stage. So our recommendation is basically to establish and track unit economics from the start. Again, the key unit economics elements can be specific or bespoke to your business, right? Again, whatever you are implementing, typically we always advise to have up to less than 10, because otherwise it's too difficult to manage, but more than 6, so that actually you have key KPIs or key indicators that are important to your business in the way you want to grow it, to track over time from the start, right? The key elements around this are the pretty much obvious 3 that needs to be part of it, that are financially related, which is your cost of acquisitions, what it costs to acquire a customer, then the LTV, basically what that customer returns to the company over time. And this is particularly important in a SaaS company, where valuation is associated to your recurrent income, not your ad hoc one-off kind of income, right? So these are 2 very important metrics. And finally, your payback period, which actually is also valid when it comes to considering investment in the later stage of acquiring other companies or acquiring new assets or equipment, is how long does it take you to recover from your cost of acquisition, right? But the same applies to how long until you recover your capital expenditures versus your initial investments done, subject to leverage. So these are key elements of 3. The rest, the additional 3, needs to be bespoke to your business and needs to be tracked, but back to actually what it takes for 1 unit of what you're selling, whether it's a service or whether it's a product. You have to to bring it back to a dollar figure that is actually in per unit rather than per volume, right? It's important because it basically builds the fundamentals on basically your governance in making decisions, but also how you're actually mapping out your path to profit journey, right? How you actually build up incrementally, how you're going to improve your bottom line over time. So this is not only about the short term, it's in terms of governance and having full visibility of what to measure and what you can manage, but also actually have other ancillary advantages that you can leverage on. All right. One of the good kind of best practices is like taking this from anywhere where you would want to actually put more resources in, let's say marketing, for example. Uh, will this actually help or hurt, right? And quantify this, right? You need to define specific metrics of returns, right? An event, for example, should have actually X time of returns for the time you are spending, right? Again, your time is valuable, and you should actually have this also as part of a founder, having this discipline to challenge yourself in where you are spending resources, including your time, right? And this refocusing on unit economics helps you in terms of governance, in terms of like maintaining profit figures, but also over the long run in having this kind of like angle of discipline that will help you to avoid pitfalls and also work with stakeholders who will help you through the next steps of your journeys. All right, so that's the second aspect. Now, this is an element that is also correlated to the unit economics and correlated to the fact to that previous kind of context where capital was flush and was deploying in many companies that were growth first, right? So growth first doesn't attract capital anymore. A path to profit is basically the bottom line for a lot of capital allocators today, right? So one of the pitfall that you need to consider as a founder, but even as a capital allocator, is to see whether actually the company has been built too fast. And again, there are corrective actions, right? There is many companies that have survived pivot, but essentially you need to build up discipline and an understanding that overbuilding the cost structure too early is dangerous for the survival of the company, right? And one of the key points underlying this, and that was part of the previous assessment of overconfidence and optimism, which is a good driver for founders that need to be counterbalanced to the fact that growth is never linear and never predictable. So there are a few elements that I've mentioned here in terms of the type of overbuilding, if you want. So bringing in a lot of senior executive, right, on the premise that will help you to have better credibility and therefore be able to raise capital before you have a product market fit. That is basically a type of mistakes that is very common, right? Again, it's important to go for product market fit first. I always advise, even though I'm helping a lot of companies to raise capital, but the best way to raise capital always going to be to raise from customers, right? So that's that important point, right? Second part is basically to build very large tech teams and saying that they will sort out the roadmap. I think this is also one of the very common mistakes that I've seen with tech startups, is basically to build the entire team before actually you have a project and a product in mind. You don't need these resources day one. You can build this incrementally, and that works much better, right? The third very common error is to sign very long-term fixed costs. Think about like a very fancy office, right? Thinking that just that's gonna attract more customers, that's gonna attract more investors. This has really changed, right? Again, remember, most of the big tech companies have been set up in garage, and there's a reason for this, and that's long-term commitments side of things. But this also includes the way you are building your solutions, right? Optimize as you can the commitments to vendors and tools, right? When it comes to AI, you're gonna need actually a number of commitments in terms of software solutions. Be conservative with the length of commitments and always favor more variable kind of solutions, even though they are in the long run actually slightly more expensive, right? So fixed costs essentially reduce your flexibility to manage your business, but it also makes it much harder for you to pivot, right? And most of the startups that I worked with, especially early on, have to have this ability to pivot quickly. You can find one customer that's going to really change the way you are perceiving your products, and you might want actually to really change the entirety of your product to service the segments that this customer's feedback has created, right? You might actually realize that the initial markets you were committed to is too shallow for you actually to have your growth path that you're expecting. You may have an investors that come in early on that is strategic investors that opening up his black box and saying like you need to service this and this type of customers and provide you with an accelerating kind of way of getting into a niche market that was initially considered, right? Or you may actually face something a bit more dramatic in saying that you are losing all the tractions in the initial markets that you had, but the product you have designed can be actually repurposed to another use. So again, that flexibility is very important, especially in the early stage, for you to be able to deliver on this and fix commitment to fixed costs will impact on this ability and your flexibility. All right, so primarily three kind of key points. On one part, it's like any kind of like variable cost is always preferred to fixed cost, even if these variable costs are higher, because actually pulling out of them comes at lower cost than pulling out of fixed cost, right? So early days is not about saving every dime, it's actually to be able to actually allocate costs that provide you with the highest level of flexibility, right? It's counterintuitive, but that's an important point to keep in mind. Now, when it comes to your hiring strategy, it needs to be done with very clear strategy, right? Your hiring process is really at the core, and it's usually one of the largest kind of stack of fixed costs. And it's a fixed cost that is high in what we call the waterfall of the priority, if you want. You don't want to not be in a position where you can't pay your employees, right? But before you pay your employees, you have to pay your taxes and you have to pay your debt, your bank debt first, right? This comes first. Then you payroll. So hiring comes very high in the waterfall, and therefore you need to actually hire with a strong strategy of clearly defined resources. And what I would advise is prioritizing employees who are learning very fast, right? So the speed of learning is very important. They need to be able to actually support your multiple pivots as you grow your company. Secondly, they need to be versatile. Versatile, which means like hands in the engines. If your operational manager can also take on a little bit of the HR management, a little bit of the accounting in the, let's say, the collection side of things, or if your sales can do both the sales, the client's relationship, but also manage collections, as much versatility as possible, as early as possible, right? These are guys that are going to be your initial kind of workforce that then going to become your middle management and your senior management. If they have early on experience and hands-on experience in multiple tasks that you can allocate them as you grow, the better. The more stickiness you have with your hire, and at the same time, the less kind of expenditures you have up front, right? That really drive your survivability for your startup early on. All right. So one of the critical components here is before you add any fixed cost, whether it's actually signing a lease for an office, tools, hiring someone, hiring a team, a senior executive, and so on. What the key question is what problem did this solve in the next 90 days, right? Just focus increments of 3 months. If the answer is positive, then go ahead, right? Again, a lot of people are making a lot of mistakes in hiring and so on. Uh, Consider this learning speed and versatility as also a stress test alongside hires that are also adapted to your stage of development, right? If you have highly competent kind of corporate potential hires versus hires that have slightly lower experience but more experience in the trenches or absorbing more volatility, you probably want to go for the second with less experience because actually they can absorb the flexibility and the volatility required for an early stage. All right. Again, one of the key points here is basically hire for the problem you have today, not for the one you hope to have, right? Sometimes a lot of founders are living in a projected world and are brought back day to day on the executions, but are primarily forward looking, right? It's important to, when it comes to fixed cost, to have this discipline of what problem does it solve in the next 90 days. If the answer is positive and it's aligned with your benchmark of returns of investments or returns on reputations, returns on growth, you decide basically what is the benchmark, but that's a very healthy questions to ask when it comes to mitigating the risk of overbuilding. All right, so now we are talking about one of the critical kind of subjects. I think we got a lot of feedback around when to raise capital, right? Most of my advice is basically as late as possible because honestly, if you can bootstrap throughout, you're not going to be diluted. You can capture all the value creations you have worked so hard to build as a founder, right? So one of the critical points here that I want to make when it comes to capital raising is essentially a lot of companies are raising way too late, right? And it's driven by fear and not strategy. All right, so it's important that you consider fundraising as a fuel for milestones that you want to achieve, never as a lifeline, right? I've seen and I've advised too many companies that were really on that lifeline kind of perspectives, and most of them were ended out with down rounds or basically bad terms for them, right? Either a higher dilution or basically a discount on their valuations that they didn't necessarily need it if they had anticipated before. So essentially 3 scenarios. If you raise too late, you're going to be considered distressed. So you're going to get bad terms from investors, right? And investors will smell this a mile away. And that includes also raising or basically doing this kind of like spray or pray kind of approach. It means like approaching too many investors at the same time. Yeah. So too late and too many, that basically leads you to bad terms. Raising too early, right? It means like, well, you're very early stage, you say, well, I'm not paying myself as a founder. Well, I'm going to raise capital so I can be paid, right? But this means also you give out a significant share of your business that have higher value than your monthly payment today. All right. So this is very important to consider raising too early. You rather put your efforts into finding customers rather than finding capital partners at that point. And then raising without a plan, right? Or raising too much. That's basically wasted capital, right? And again, having the discipline of not expending it is typically very difficult, and that's not going to pair well for you in your next round, right? So again, it's very important to raise only what you need, no more, no less, right? And this also applies to debt packages, right? So very important to plan ahead, right? So you raise money when you don't need it and not when you're desperate. And then more granularly, really target prospective investors that are strategic first, right? That have additionalities that you can convince them that they can provide you with operational efficiencies in entering new markets, for example, in penetrating new segments. That's on the go-to-market side that can provide you with more discipline when it comes to operations from experience and, for example, in the industrial manufacturing side, or whether they actually can help you to contribute to certain kind of capital efficiencies, right? But again, always prioritize strategics to investors to other investors. When it comes to investors, especially more institutional investors like venture capital funds, for example, there are two aspects to consider. One is there's a cycle. Every vintage is basically divided. I mean, these funds have a fund life of 10 years. You have basically 3 years of deployment, about capital raising and deployment, 3 years of building efficiencies in the portfolio companies, and 3 years of basically divesting with one buffer year. Yeah. And the buffer year can be early on in raising capital, can be later on in divesting, right? But that cycle. So you need to understand a VC funds kind of cycle, where they are. If you can see it's been raising capital in 2017, 2018, it's unlikely they'll be able to actually deploy any tickets into new companies, right? So there's no point targeting them. The second part is the investment thesis, right? The investment thesis is the mandate that their limited partners, their backers, have invested in their funds for them to deploy. So alignment of this mandate is very important. So the way you present your opportunity, your company, needs to be aligned with this mandate. If it's a company that only invests in healthcare and you are not in healthcare, there's absolutely no point of wasting the investor's time or your own time, right? Again, capital raising is very time consuming, and it's time consuming at the expense of other ways of capitalizing your business, i.e., meeting customers. Yeah. And finally, once you have identified your prospective investors that have strategic additionality, and basically that you need to be prepared to present your company in the best presentable way, with the right tools, but also to give them no reason to say no, right? From my experience as a capital allocator, it's the only discipline that we have as investors is basically to find reason to say no as early as possible. So that reason to say no should be a driver for you to have the discipline of understanding and have a full rounded kind of story around your business, so that basically there's no reason to say no, and you can go into the next stages to secure capital. All right. So when to raise, how much to raise are very important, very strategic kind of elements of your company. And one last iteration around this, because raising capital also include the IPO side, right? So IPO is not, for me, it's a capital raise exercise. It's not an exit, right? And it's an important point to understand that this will transform your company completely, right? It's going to really reduce your capacity to pivot massively, but it will give you liquidity and control that you don't have before, right? So IPO are very good as far as you have first of all, the capital to prepare for it, but they are very good exercise for you to actually have one directions that will be anchored and then disciplinary executed over the years once you are ready for IPO, right? But again, that gives you liquidity and more control, but less ability to pivot. But IPOs are part of the capital raise, and still need to actually tick all these boxes in terms of planning ahead, being prepared to entertain the target prospective investors through analysts and basically not giving them any reason to say no in maintaining momentum for your valuation as a public company. But when you shift from private to public company, things are much more public, right? So your competitors have full access to all your strategy and so on. You need to be predictable and you need to actually stick to one direction. So that's for later stage, but I close these brackets. Okay, next, this is primarily for slightly more for the scale up, but I think it's a good discipline to have as early as possible, right? So identifying, assessing, and prioritizing risk is very important, right? Again, one of the key questions here, and again, I'll go and loop back into the contents there, but having the discipline of every 3 months, what could realistically kill us in the next 12 months is a very, very good sounded question to ask at board level on a regular basis every quarter, right? So every quarter, you have your financials, you have your forecasts and your actuals, and you have the variance between them. You may have boosted in some areas, you may have like blasted your budget in marketing. You may have like saved money in other aspect and so on, but basically that gives you like a bit of the bottom line. But having the risk level on top of this, of um, imagining and defining actually what are the critical risks to your growth, will have the greatest impact on your survivability as a startup. I'll give you one personal example. I had 80% of the entirety of the South Pacific Islands market for telecom equipment, right? And these were public tenders for 3 years. So it was great. No problem at all. What I didn't anticipate is the risk of basically convincing that the renewal of these tenders would be encompassing a service component, not only the products procurement, right? And that's what tanked one of my companies. Yeah. So again, the risk can be more about macroeconomics, can be specific to the way you are dealing with your customers, can be the fact that you are too reliant on one or two customers, can be the fact that you are dependent on one technologies, you are doing applications, but you are based on the platform. What if the platform double their price points for using the platforms? Regulatory changes, right? How exposed are you to be regulated by MAS in Singapore, right? The risk of talents, right? So key talents running away, right? So if you lose your CTO tomorrow, is your company still viable, right? So all these are very important points, and that actually discussing them with the key stakeholders for each of these risks actually already mitigate the risk, right? So this is very important to do this as early as possible, not only for having visibility on short, on medium, long-term risk, but also actually to build stickiness and communications and that binding kind of like a way to build your core team, your earlier core team, right? So finance here plays a role of quantifying it, right? So we in finance quantify that risk, right? We put a dollar figure to it in sometimes risks that are very ethereal, right? But we can actually provide you with a quantitative analysis to that risk and then advocate for correlated buffers. What kind of buffers we're talking about, right? So buffers is basically your primary thing is to put some cash aside, right? So you have three kind of like way of putting cash aside. Some that is general, right? So we build a extra runway, a longer time to cover monthly burns, right? That's basically generate, right? It means like you're putting more cash aside. But then you have more specific uh, allocation of cash, which are called reserves. Reserves are basically allocated to a specific area of your budget, right? So we are building reserves so that basically we can build a new marketing program, or we're putting reserves so we can build the next stage of our tech teams, right? And then you have contingencies. Contingencies are more associated to investments, right? So you want to invest into a new technology and you want to acquire the IP, right? You are slowly building contingencies in case that doesn't actually pan out, right? So reserves are more positively outlook about putting cash dedicated to a certain task. Contingencies are more like in the case the shit hits the fan. Yeah. And then you have basically the what we were talking about fixed cost, building flexibility in your cost structure, right? So more variable cost, less fixed costs. That's important also in building these buffers, right? And finally, what you should ask from your CFO or your finance team is to build downside scenarios. But actually, just building scenarios in general is a very healthy way of involving finance in a strategic way, right? So you build your sensitivity in terms of like a bull, a bear, and a medium conservative way that gives you better visibility of the likeliness of reality over time, right? So it's always like future looking, and you can build these downside scenarios or these scenarios at any kind of horizon, right? But essentially, this has to come back into what kind of risk you want to mitigate, and at the same time, what kind of strategic decision you want to justify. Okay, so again, hope is big driver for a lot of early stage founders, and again, that should still remain a great kind of mental element in terms of being interested in creating startups and creating new businesses. But planning is really the underlying kind of core to strategy, right? And finance is here to really help in defining this from modeling perspective, from building buffers that are healthy for the companies, and again providing early stage founders with the flexibility to make decisions with their IPOs and also to pivot if things are required from an opportunistic perspective or from the shit hit the fan kind of perspective. All right, key takeaways here. So finance gives you really clarity. It's not about providing with more complexity. Again, you need to implement a number of tools, and that seems to be overwhelming, right? But this is really to advocate for more clarity, right? In essence, cash give you time, right? Not revenue, really cash on the table. They give you time. That's your runway. Times gives you options. Really, that's really how you map out both the potential of growth, the opportunity to get into new markets, the opportunity to actually acquire new businesses, the opportunity to onboard new strategic hires, um, or basically your opportunity to offset some of the major risk and build your moat, right? That will create a better resilience around your business, right? Time gives you options, right? So it's all correlated. And for this, to understand all these parameters, you need awareness around your financials and to involve actually your finance into the key elements that are defining your strategy going forward, right? So building a finance mindset is core, and this needs to be supported by strong kind of tools, right? Again, best founders don't love finance. Most of it is there's a lot of sometimes very vocal type of exchanges. but it's essentially they need to respect it because actually they provide this kind of visibility to make better decisions. All right, I'm going to wrap up with a few things that we've done at Salamander. Uh, Essentially, I will not read through all this stuff, but essentially we've basically worked with a lot of startups, scale-ups. We have engagements on M&A as well. We worked with VC funds and PE funds as well, and family offices. And basically, we've condensed basically what we can do in terms of deploying kind of C-suite fractionals into companies. And we define this into three curated packages, right? One is basically focused on helping you to succeed in your fundraise, right? In the current context is very important, but basically through experience, we can build you both from the historical perspective to a projected or future oriented perspective to basically give you a much better understanding on how to present the financial metrics, the financial side of your business that is reasonable, understandable, and that doesn't give any opportunity for investors to say no, right? At the same time, we also build this in terms of coaching founders in basically how to actually present this. And finally, how to accelerate due diligence, right? Due diligence can be a very lengthy exercise. So basically, we know actually what investors are looking for, essentially, and just basically helping to messaging this in accelerating the fundraise program as well. So that's the first kind of more deliverable kind of oriented package. The second is really about how to build governance and the key tools, right? Across the various mistakes or the various kind of elements to avoid that I went through the presentation here. These are the key typical elements that are key tools that needs to be implemented, right? So your three statements are very important. Obviously, your income statement, balance sheet, and cash flow. When it comes to income statements, this is also the basis for you to build your performance, which means how to actually project your financials over time. So all this, having this really uniformed and automated as much as you can, is actually very useful to build more strategy within your finance and stuff, really crunching numbers and trying to get all the numbers together. The second part is very important, is your cash management tool or working capital toolkit, right? This is really about how to manage liquidity. This is survival mode, what you need, your 13-week, understanding your cash cycles, basically managing your cash, your runway, and so on. But that will also be useful strategically to use for future decisions. How would this look like if we hired this guy, for example? You can ask finance to model this and to add this to the cash management and see how it looks like in terms of how compressed it makes your runway, right? So these are important. Then you have really the small strategic tools, which are more the accounting, management accounting, all around your unit economics, but this is highly specialized. So every company would have a different one, right? What do you want to see? What do you want to measure? What do you want to manage, right? And then having dashboards so we can actually do proper reportings to investors, to your shareholders, and so on. And finally, a more governance package that gives you like a more mature kind of way of or better questions being asked at board level, right? So no surprises for you as a founder when your investors, your shareholders, or new shareholders are coming on board, and how all this new cap table is working all together, right? It's all about anticipating risk as well. And finally, something that is much more practical, it's more for really more early stage techs, but we offer basically shoulder to shoulder operational finance supports where we are setting up mid-career professionals in country who speaks the local language, Bahasa, Tagalog, or you name it, or Vietnamese, and basically help you on the day-to-day. And basically, we are here as more senior C-suite to basically providing supervisory support. And this can be done on a weekly basis, bi-monthly basis, a monthly basis. And we both talk to the talents we deployed, that we trained and qualified, but also to the founders and the founding team to align basically, and if required, corrective actions mechanism can be implemented, either replacement of the operational finance support team, or basically us as C-suite to drop in and assist where needed. Again, companies are evolving fast and different profiles that requires at different phases. And I will conclude here.